latest inflation number was 6.1. And of course, everybody's jumping up and down. Big deal. I mean, I've been on TV. You've probably been on TV, radio, etc. I'll be honest with you. I was underwhelmed. I actually thought it would be a higher number. Market was calling 6.5, 6.1. I don't like it, but I'm not that unhappy about it. I don't think it's a disaster. And that's just and because I look at some of the components, and we've got to wait for this to wash out in the next couple of quarters. But I mean, I see, one of the components of the 6.1% is a 20% increase in house pricing year on year. That's just a big number. 32% increase in petrol prices. Well, but that's historic because petrol's now coming off. House prices now coming off.
Yes.
If I go from last quarter to this quarter, house prices are down. So and
so will petrol be,
and petrol too. So if I then push that out over a 12-month period, if I adopt Chris Joy's a theory or hypothesis, house prices will be down by 20%, not increasing by 20%. There's going to be 20% reversal,
clipping a lot off the CPI number.
So the CPI number will actually go back the other way. So I'm not that unhappy with what I saw. How are you feeling?
I was forecasting a higher number too from what we knew about the various components, bits and pieces about food prices and things. And by the way, a lot of vegetable prices will start to fall too because they're growing them again up in northern New South Wales and southern Queensland where they grow our cauliflowers and beans and lettuces. It takes a while for them to grow, but they'll get washed away in those floods, but they're growing. So Woolies and Coles will start selling for $3 instead of $10. So that'll take inflation lower, the way the Bureau of Statistics measure it. The cost of those things are going down. Now, I actually look at a lot of these sorts of indicators about how financial markets reacted. And when that number came out, you thought, oh, gee, 6.1. It's got all the headline news. And as you said, I've had...
By the way, that's the headline rate.
Correct.
As opposed to the underlying rate, which
Correct.
is 4.9.
Correct, which is a good 1.5%, or 1.2%, I should say, is quite a deal difference between the two measures. But so got all that media coverage and fair enough too. Like it is a 20-year high in the inflation rate. But the money markets saw this number, also factoring in a higher number, and in the couple of hours after the number was released, and money markets trade, as you know, Mark, every minute of the day virtually.
With the best information.
With the information and with people putting their money where their mouth is, not just mouthing off on TV and radio. They're actually putting their hard-earned cash and their investor cash into the money markets. The expected peak in interest rates got trimmed by around 15, 18 basis points. So almost a full 0.25% was taken off just on that one economic release. And if you're right, and I've got a sneaking suspicion you will be, that maybe not in the next quarter or two because there's still a momentum on energy price, like electricity prices and a few things like that that'll impact our inflation rate for the next quarter or two. But come January, February, March next year.
The February meeting, yep.
With assuming oil keeps coming back down because demand's slowing and oil production's gone up. Things like lumber prices, timber, wood, a very important part of housing construction. International freight, shipping rates. So when you're importing stuff into Australia, the cost of that container on the back of the ship went up 5-fold. It's now dropped 40%. Things that probably clearly don't impact everybody's everyday life. Copper and nickel, they're down 30 and 40%. Now, copper's in wires and stuff. They're the manufacturing costs. And that's why the price in the CPI number that came out yesterday had electronic goods going up 5% in the quarter. There's a lot of copper and metal and steel and all that stuff in a fridge and a washing machine and a microphone and goodness knows what. So I think by the time if these trends in global commodity prices, petrol prices, wood prices continues to flow through the economy, we'll see it probably first overseas rather than in Australia. So look at US inflation data the next couple of months. By the time we get to the early part of 2023, I'm pretty confident, about as confident as I've ever been, that inflation number, just as quickly as it went up, will be in the early stages of it coming down. And our friends at the Reserve Bank will sit there and think, thank goodness for that. They'll have hiked a few more times. By then, housing will be a little bit weaker and they'll probably think, thank goodness, we've done enough. Let's just sit tight.
And wait. And
watch that inflation momentum, as I said, as fast as it went up from late last year to now, or late this year, it'll probably come back down.
So you just made a really good point, Steve. So you were talking then about supply side inflation pressures, okay? Supply side. And you're saying that those things should start to unwind over the next period, whatever the period may be. And I think just by way of example, just one example, but I think there's also going to be demand side reduction as well. So let's take construction. One of the things that drives the construction industry is the price of money, because developers can't borrow money to go and do the development. So they're saying, you know what, there's no point me building this block of a unit because it's going to cost me too much money to build it, one, plus I can't borrow the money and interest rate's too high. The banks won't lend me the money, but the interest rate's too high. And anyway, one of the conditions the banks impose on me is I've got to sell half before I can draw any money down. But by the way, the cost of timber is too much, the cost of carpet is too much, the cost of steel is too much, everything's too much, glass too much. Electric
wire.
So they order less.
Yeah.
And people who are building houses, there's a lot of houses to wash out. There's in the middle building houses, but for those people who are about to build a house, are going to say, I might just hold off a little bit. Because it's too expensive. It's, the builder give you a quote to build your house. Oh my God, it's much more expensive than I expected.
Yes.
So I'll hold off. So I think there's going to be some demand side relief on the cost of that, on that example, construction.
Indeed. No, you're 100%.
I think we've got a double whammy coming in early next year.
Yep.
I think if there's all the stuff that's in progress, it's started, will wash out between here and the end of the year.
There's some momentum in some of those things.
And a little bit of runoff to next year. But your point, the supply side will start to become much better in terms of inflationary pressures, price pressures. And I think on the demand side, we're going to get that too. And by the way, we know the lead time. Now, the lead time for starting a new development out at, Western Sydney or the West, wherever it is, it's years. They have to get approvals. They have to get the plans approved. You have to do all the earthworks and all. You have to build the streets and there's a million things to be done. Then you got to pre-sell, and people are still in a hangover about prices. And
then you got to build it.
And then you got to build it. Correct. So
there's a long time lag.
So there's a big lag. So I've got a gut feeling that come February, March next year, I hope you're right. I hope we're both right. That the interest rate rises will be enough to get us through to where we need to have, let's call it a soft landing.